Hello friends, this is Ankur from Finstudyclub.com. Welcome to the session on reading 22. This is basically a continuation of the video series that we are creating for study session 7, and this needs to be looked at after looking at the video on reading 21. So welcome to a very small, almost like a 13 slider, which is not going to take us more than, let's say, 20 to 25 minutes. Involves a lot of calculation, so I hope that you have got your calculators with you. What I would like to start is a very simple recall of a level 1 concepts as to what are the 6 steps of the financial analysis. One of the very important step is, why are you doing this analysis? This is exactly a recap from level 1. Once, let's say, the answer comes as I want to evaluate the credit worthiness of a company, then you start gathering the data and you have a whole lot of sources. Then you start processing the data using things like ratios, common sizing, regression, charts, graphs, etc., and then start interpreting and analyzing the data. So you're basically answering the question that are being asked at stage 1. Once done, you will formally write it. As a report, and if it's a periodic analysis, then you are going to repeat the 6th step. You basically of updating it. So updating it basically means to redo all 5 steps put together. Okay, commonsensically, if you look at your core books and different books, so the output of every step is going to be the input of the next step. Fairly simple. I mean, I hope that is very clear. So give me a a commonsensical answer. If, let's say, I'm talking about the processing the data, what is the input for this? The input for this must be whole lot of raw information that would have flown down from step 2, and the output of this step 3 should be a properly formally laid out ratio analysis, on the basis of which now this becomes the input for analyzing, and after analyzing, the output is going to come up with some kind of concluding remarks, so on and so forth. So that's how the cycle keeps on working. So output of every step becomes the input for the next. What is very critical is step number 1, because that tells me where do I need to put my stress on in point number 3 here, because there is no end to kind of doing the data processing, and obviously there are a million ratios that you might create out of the entire balance sheet and P&L. Okay, so therefore point number 1 becomes very critical in that sense. The way this particular reading has been explained is extremely critical and very creative. I must say that. Rather than kind of putting it, theoretical comments and writing long paragraphs, what they've done is, core book has very beautifully taken one particular case and they have analyzed that case, and at different stages they are using different ratios. So that's exactly how we are going to also do that. For simplicity's sake, I have taken the company called Shriram Pistons and Rings Limited. This is one of the public companies in India. By chance, as a matter of fact, it is not listed. So, my particular point of taking this is, it is still possible that a company not listed but still gives you adequate information. Pretty much. If you look at the annual report, it is fairly comprehensive and descriptive. Well, there are too many ways of analyzing a particular thing. So I'm going to take help of something called as a DuPont analysis. And this is a ratio analysis technique which decomposes the return on equity into 5 different components. Actually, 3 different components, and the first component of net profit margin is further divided into 3. So let me put those 3 into one bucket. Call it net income. EBIT cancels, net income upon revenue, which is net profit margin. Within net profit margin, there are 3 aspects. One, how much is the tax portion, how much is the interest cost, and finally the operating profit. So that's how you decompose your entire return on equity, just to ensure, I'll cover that in the end also, that every single component is getting adequate leverage, adequate attention. It is sometimes possible that a company is doing very badly in this but is doing very good in this aspect. So this particular good aspect will overshadow the bad aspect, and it will appear that return on equity has done reasonably well. But the idea of decomposition is to highlight the areas in standalone ceteris paribus basis, so that you can have an objective assessment of the strengths and weakness of a company and can kind of improve it upon future. So I'm going to kind of just take a couple of points here, that the decomposition help us analyze different aspects of the firm without letting one overshadowing the other, like I said. And every company needs to be also analyzed on the basis of its own operations only. I'm going to come back to this point. In a while. Okay, so here is the balance sheet that I have taken, and for the sake of data availability, since the latest annual report wasn't available at this time of the year, so I've taken the previous annual report. So to that extent, my data will be a little my analysis will be a little dated, but nevertheless I think the essence of it could be understood from here. So I have FY15 as the current year and FY14 as the previous year, and this is the equity and liability side. These are the subtotals of shareholders equity, non-current liability, and this is the current liability, and so is the asset side, wherein these are all the non-current assets and these are the current assets. Clearly it is a classified balance sheet where everything upfront you can see the differentiation between the current as well as the non-current. What I would in specific like you to understand is, out of this non-current and current liability, which are the financial liabilities, because I'm going to make use of them later. So my long-term borrowings appears to be financial, my deferred tax is purely operational, other long-term liabilities also appear to be operational, because if these would have been financial, I would have classified it under borrowing. So out of the four, only one is financial. I'll tell you where I'll need those figures. In terms of the current liability as well, this will also be a mix of operational and financial. So let me just select the two. So short-term borrowings appear to be financial, trade payable operational, current liabilities operational, and short-term provisions operational. So all I'm trying to say is this is financial and this is financial. Rest all are operating. Okay, this is something that I wanted to kind of just highlight this point up front on this slide. This is like the income statement. I know the font is not going to be as good as you would like it to be, but for the sake of taking the snapshot from the PDF, just let me just highlight key figures. 573 is the profit for the current year, which was 696 last year. So overall the profitability has gone down, and that's how we are going to manage that. So this is your PBT. There is no EBIT as such given. So how can you calculate your EBIT? Fairly simple. Profit before tax, you add back the finance charges. So finance charges, if you can see, is right here, finance cost. So if I add back 320 and 378, then I'm going to get something called as EBIT. Why I'm telling you so? Because I would need all those figures to fill in these 5 data points. Return on equity, which will we calculate for the last year as well as the previous year, so on and so forth. So all 5 components into 2 you will have to calculate right now upfront with me. Let me just give you a very, very simple hint. The total asset upon total equity. So this is something that I will need my balance sheet for. So here is my calculator. For FY15, the total assets are 11,889 divided by the total equity is 6072. So 1.96 is coming as the number. So I'm going to write this 1.96, whereas the same number for last year 11935 936 divided by 5599, 2.13. So that gives me a number of 2.13. So just look at this particular aspect. Your leverage in the current year has gone down, because of which your return on equity would have suffered. So this kind of an analysis is something that I'm going to do right now. Okay, so let's talk about the second aspect, which is revenue upon total assets. So for that I will have to kind of go to my balance sheet. Let's talk about the first year, the current year. So my total asset is 11889, and my revenues is, let's say, let me take the net revenue is 12443. So 12443 divided by 11889. 12443 divided by 11889 gives me a number of, let me change the color, 1.05. Okay, beg your pardon, this was for this year, FY5. So 1.05 travels to fiscal year 15. Let me tell you what was the number for FY14. Now for FY14, the total assets base is pretty much the similar, which is 11936 here. So this number divided by 11936, so it is 11697 divided by 11936.98. Last year, let me change the color, yeah, 0.98. That means in the current year you performed bad on this, but you've performed well on this front because your revenue has gone up. Similarly, let me just fill the entire these three figures into two as well. Yeah, so here is the slide which has been filled up using the information on the previous two balance sheet and income statement, and this is where I get to that if I compare with the last year, we have done a good job here. We have done a good job here, but we have done a very bad job here and a good job here. So overall it's been a mixed bag. It's been a mixed bag. So what it does is that the entire return on equity of both the years, these five things that I was talking about, results into the final ROE presented like this. So you can clearly see that there have been overall a downfall, and the reason for that you can clearly identify is to be this particular aspect, which is sizable downfall. It is 0.9, it is almost going to 0.6, so there is almost like a 33% drop here. Okay, obviously there is a little bit of drop here, but that is not to be attributed in a significant manner. So in spite of 1, 2 and 3 components doing well, this particular aspect has really, so the delta between the two is the finance cost. If you look at the finance cost, the finance cost really has played not a should I say a hero in this entire game. They've in fact been a very, very strong villain. So that's how you keep on kind of calculating and analyzing different aspects of a particular case, and the decomposed aspects kind of keep on becoming clear to you. So I hope that this DuPont analysis practically is clear, and I also hope that you will go through the example that is given in the core book, and they're very beautifully explained that. So it's a must visit slide, but it's not going to take you more than 5 minutes to kind of now look at it. Okay, so moving to the next slide. The slide that we are now talking about is absolutely the same slide that we have already talked about once, and talking about reading number 20, the quality of financial reporting. And that's where I had said that whatever PAT or net income that you have needs to be segregated into, in a way, three components. One, the cash; second one, normal accrual; and the third is the discretionary accrual. Now sometimes it is very difficult to distinguish between the normal and discretionary accrual. So because of that, I will differentiate it into two. One is the cash component, the other one is the accrual component, and that's where my next important topic starts. Very, very critical from an exam standpoint. Your accrual component of the net income. So wherever, let me just kind of give a strong disclaimer. Whenever in the calculations you tend to get lost, please understand that you are trying to calculate the accrual component coming out of your PAT. It is going to come as a percentage. Okay, and like we have already discussed, lower the percentage, the better it is. Please keep that in mind. So you measure it using an accrual ratio, which comes as a percentage. Your accrual ratio is basically the increase in the accrual divided by the average accrual. What is an accrual, by the way? It is the net operating assets. I'm going to come to that in detail, and we are going to calculate it together. Your net operating assets is nothing but the assets minus liability, operating assets minus operating liability. The closing minus opening, this is called as your change in net operating asset, and closing plus opening divided by 2 is something called as the denominator. So it is fairly simple to calculate, fairly simple to calculate. There are broadly two approaches to calculate the same percentage. One is the balance sheet approach, the other one is a cash flow approach. They might give you different numbers because honestly speaking, they have the same denominator, but they might have different numerator, because of which you might have a different accrual ratio. Okay, so the point is, you got to handle that uncertainty. It might be same in a particular case, okay. Let's talk about, when do you call something as an operating asset? Honestly, my entire asset is accrual. My entire asset is operating, except my non-trade investments and the cash that I hold in hand. All the liabilities are operating except the financial ones. So pretty clear, and in that sense. So I will take your attention again to the point that we've already done, that in the entire scheme of things, this is financial and this is financial. So out of this, if I deduct this aspect, out of this I deduct this aspect, that's how I'm going to get operating liability. Let's do that up front. Same for the case here. In case of operating assets, if out of the total asset I reduce my cash and cash equivalents and any non-current investments, okay, this is an investment which has not been done in the trade, so this needs to be excluded. Now again, there is a lot of subjectivity, and that's where reading of annual report will come into picture. The question is, will you exclude these long-term loans and advances? The point is, let's say from Shriram Piston standpoint, I have read the annual report and I found that these were given to the employees, and obviously this is therefore part of operating. But if, let's say, you believe that giving loan to an employee, let's say for the purpose of building his home, or let's say as for let's say wedding of our daughter, or whatever else, so all that is non-operating, so you might want to exclude that as well. Okay, so it depends on analyst to analyst, but in my view, I'm not going to exclude that. I'm going to keep it limited to the cash as well as these non-current investments. So let us just calculate the operating liabilities at and operating assets in both the ends. Yeah, so I have just calculated few figures here. Let me just take you through this. Operating liability is 3139 minus 217 plus 2677 minus 1964. So it is coming out to be 3635. Similarly for the last year, my operating assets are the total assets minus 290 and minus 0.5. I am taking this part as operating. You as an analyst might want to do it otherwise. And same for the last year. So what I've done is I've calculated the net operating asset, which are coming as 11599 minus 365 7964. So these are rupee in million, whatever is the unit. These are the amount which is invested into the business as far as the operating aspects are concerned. And the same number 8108 is coming as the opening value. So the change during the year has been a negative change, which is a good news for the company, by the way. The accrual component has gone down during the year. The average is coming out to be 8033. So what is the accrual ratio that we are talking about? It is 137 divided by 8033. It's talking about this particular number. We're talking about as 1.7% negative. This is the number that we are talking about as far as the accrual ratio is concerned. Well, there is another way of calculating the accrual ratio. Like I said, the cash flow approach, and in the cash flow approach, the denominator remains exactly same, the average of the net operating asset. It's just the numerator that changes, and the numerator here is a fairly simple calculation of your net income, which is 573 reduced by CFO 1293 and as reduced by CFI. So a negative CFI will mean an addition. So here you are getting 273. Okay, in the previous year, the same number is 648 453. So if I have to do closing minus opening, I am getting a number 273 minus minus 453 coming at, so there is going to be a net positive thing here. So this is 453 minus 273, 180 positive, and 8033 is the same denominator, coming out to be 2.2%. So like I said, that the answer in both the approaches might be a little different. Here I am getting minus 1.7, and in case of cash flow approach minus 1.7, and in case of cash flow approach I am getting 2.2 plus. Point is, these are not comparable to each other, honestly speaking. What you need to compare it with, is this particular aspect. Take, let's say, the balance sheet ratio. You have to find out that it should be lower the better. The more stable it is, the better it is. If it is fluctuating, then it's a matter of problem. Okay, accrual ratio is suggestive, not conclusive. Again, the same genesis as I've been keeping all throughout in this particular study session. And if let's say it is pretty high, then it raises some concerns that you got to analyze and verify with a little more data analysis in that sense. So what you have to understand is that your 2.2 is not comparable with 1.7 negative. This 2.2 is a cash flow basis. You have to calculate a time series analysis on the basis of this cash flow data itself. You have to calculate an independent time series analysis based on this balance sheet approach. So this balance sheet number needs to be compared with the respective balance sheet numbers, and this cash flow will be compared with the balance sheet rate. So both of them needs to be read together, and any concerns need to be addressed in that sense, put together. Okay, so I hope that is very, very clear that you don't have to compare the balance sheet number with the cash flow function. Okay, so with that, I'm moving to the next part. Well, coming to a very, very interesting aspect, pretty much towards the end of this particular, reading, we are basically trying to say that whenever you are assessing a company, I mean, let's take names. I mean, it is going to become much easier, for that. Let's say I'm trying to evaluate Shriram Pistons and Rings Limited. Okay, this is my company, and this has got a value of $100. I'm taking, it's not a market price per share, I'm talking about MCAP overall. Okay, but this company, Shriram Pistons and Rings, have made an investment into a company called as Investi, whose value itself is $30. And the investment that they have made is to the tune of 40%. That means in the entire valuation of Shriram Pistons, 30 multiplied by 40%, $12 are being derived from the work that Shriram is not doing, but his investee is doing. So what this particular slide talks about is that while evaluating Shriram Pistons, it is absolutely mandatory for you to analyze the Shriram Piston in stand-alone basis. I'm taking you back to a particular point while I was talking about the DuPont analysis, and this is the point that I had said that I will cover up a little later. This is where it comes from, that the company should be analyzed only on the basis of its own operations, only Shriram Pistons and Rings, excluding all sorts of equity income, excluding all sorts of subsidiary profits. How is Shriram Pistons on a stand-alone basis, that too after removal of all these things, is performing? So so this is exactly what is the decomposition part which talks about here. So overall, the decomposed market cap is going to be $88 dollars in that sense. And obviously you are aware that your price to earning multiple will also include the price from here. So like this 100 is split into 12 and 88, this price multiple could also be split into pure investor and the investments that are coming up. So obviously, let's say if you look at the ratio here, it is coming out to be 88% and 12%. So maybe this is the very, very healthy ratio to be in, where the investor is, my company is deriving 88% of its value only and only from his own operation. So it is very, very stable and a straightforward scenario. So this is like a very small formula which is kept, which you can easily find out. This is not very difficult. So the value derived from ICI is going to be $12, and $88 is what as a balancing figure I derived purely from it. Okay, so this is almost like towards the end of the reading, and this is there are the four off balance sheet liabilities which the analyst should be very very careful about. This is something that we will talk about in detail through an example, converting an operating lease into a finance lease. But all three are also some sort of a liability which the accountant very smartly takes off from his own books. Imagine a debt guarantee that you've given for someone. Now obviously there is a guarantee, there is an obligation that you can foresee, so you got to include that on the liability side. If you have sold your receivables, but there is always a recourse clause, that means any time the liability can come in, so you got to reinstate that liability. Currently it is off balance sheet, it is not on the balance sheet, but you got to bring it on. How do you bring it on? Very simple. You increase the liability and increase the asset by the similar amount. Very very simple and straightforward. Sometimes it might be might be appearing to you that these two balance sheet are let's say the same thing. Asset 100, liability 90 and equity 10, compared to asset net 10 and equity net 10. Well, this scenario, if you look at the net asset, equity remains same, but all other things are very very different. Why I'm saying it? The leverage ratio, debt to equity, is going to be huge, 9 times, whereas the leverage ratio, the debt to equity, is going to be 0. So a net of balance sheet is going to signify as if the company is absolutely riskless, and a fresh loan could be taken at a very very low cost if you have netted off things. But if you have grossed it up and have shown it at a total liability level, then basis the 9 times risk, your lenders are going to charge a bomb for it. So that is what the liability is being taken off balance sheet, and the new balance sheet becomes like this. This is what the accountant will report, and this is what will contain an off balance sheet liability of 90, and analyst will have to convert it back to a gross basis. Okay, so this is what is basically the genesis of what an analyst has to do.